Looking for the best opportunities in Perth property? Get the local area expertise you need from Momentum Wealth, WA's trusted property investment consultants. Market insights, advice and representation from award-winning buyers agents and REWA Hall of Fame inductees. Visit Momentum Wealth's website at momentumwealth.com.au to organise your obligation-free consultation today.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Welcome back. Thanks for tuning in. Fantastic to have you with us. Alex Whitlock here today, stepping in for Phil. Great to be on the show. Look, I thought I'd catch up with a guest that we had on a few weeks ago. I don't know if you have been keeping in touch with the podcast. We had OpenCorp on. We had Cameron McLellan, and we also had Michael Beresford. They are directors at OpenCorp. We had a pretty fascinating a view from them as to where the market's headed. We also had a pretty interesting look at how COVID had impacted all the markets, really the sort of the psyche of the investor, and also just some of these sort of environmental things that had affected the property market, from lending policy through to the RBA, through to really taking a bit of a retrospective look back at the market cycle, sort of back to 2017. Cam, great to have you back on the show.
Thanks for having me back, Alice. I was going to say you called me Cameron then. My mum calls me Cameron when I'm in trouble, mate. But no, great to be back.
You see, the thing is, being old-fashioned, I thought I would introduce you as Cameron, and then Cam. I know you prefer to be called Cam. I'm a stickler for doing things the way I've been taught in terms of journalism.
But old school, mate. No dramas at all. All good. All good. Great to be on.
Mate, I thought it would be good. Look, I know we didn't really talk about this during the first chat, but the reason why we had you on the previous show, you're an investor. You've been an investor for many, many years, and you've seen many, many market cycles. And we talked about, sort of what lies ahead, but I think it's really important for investors to get a bit of a look at what's happened previously, because you learn a lot from looking at market cycles. There are some things that endure. There are some things that change gradually over time. But looking at the market cycles, looking at how property performs, looking at the repetitive things that you can tap into is extremely valuable. What started you on your journey?
It's a ripping question. I think everyone as an investor gets what I call that light bulb moment. And some people get later in life and it's sort of like that, oh, hell, I've got to do something fast here. I was probably fortunate in some ways. I didn't have a bad childhood, but I got my light bulb moment really young. I was sitting in the back of my parents' station wagon and heard them arguing over whether they should buy milk or bread because they'd just been through a failed business venture and lost a motel that they'd purchased and the family home. So we had to move up to my grandparents' place, and we lived in a tin shed for 6 years while we built a mud brick house, and they got themselves, sort of re-established. So while I didn't have a bad upbringing financially, there wasn't a lot going around. So that light bulb moment when I heard and it really sunk home how destitute mum and dad had got was when they were trying to negotiate what they were going to buy, milk or bread. Right then, I knew that I wanted a better financial future for my future family than I had at that point in time. So from that point onwards, I started investigating what options I'd have to be better off financially. I probably wasn't smart enough to comprehend shares and investing in the stock market, but I knew wealthy people had property. That was obvious to me. And somehow I stumbled across, and I always tip my hat to her, I stumbled across a VHS video of Jan Summers, probably the matriarch of Australian property investing. She's had some ripper books, which are obviously somewhat outdated now, but the core lessons are not. And the VHS video had Jan with a ripping pearl and some big shoulder pads jacket. And some of the fundamentals in that really sung true. So land appreciates and buildings depreciate. There was a visual on how to buy one property and use the equity to that to duplicate and buy multiple properties. And that was really what spurred my interest in property. And that took me down the journey and that was my light bulb moment.
Going back to the 90s, Jan Summers was really the architect of changing the fortunes of many regular Australians. And you talk about, sort of property being for the wealthy. Jan really opened property investment up, demystified a lot of it for hardworking Australians, showing that all investing starts with saving, and it's not about how much you earn. There's plenty of wealthy people who waste all their money and don't have anything to show for it. So she really educated investors about, first of all, saving. She was very, very focused on driving down, the repayments in your own property. She was an educator in terms of the tax effectiveness in terms of property. And I read the same book, and it's exactly what got me into investing, probably around about the same time.
There you go. So it's been a great journey since then. I left home at 16 and started working, and that was in the midst of the 90s recession. So I was working 3 or 4 jobs. I think Joe got smashed in media a year or so ago because he said, young Australians have it easy nowadays and they need to work a couple of jobs and they eat smashed avo all the time. And I remember he got belted in the media pretty hard. And I don't get into politics. I sort of agreed with him because I worked 3 or 4 jobs at that point in time, just desperate to get that deposit together. And I didn't go to a cafe till I was probably 25. So I think really knuckling down hard and delaying gratification was one of the keys to getting that first deposit and getting started. So it took me a number of years to get the deposit together, but I think it was another light bulb moment coming investing. I think I was earning 22 grand a year back then when I bought my first property. And by the time I'd settled on it, it had gone up about $40,000.
Wow.
So you go, and that was, I was lucky I had someone to guide me early days, but that was another light bulb moment of how powerful buying property can be.
So you're obviously very driven. You've given us a really good, clear vision of your motives, but it must have been frightening at that age when you've worked so hard. And what did your first deposit look like? Let's just get some context as to what you'd saved.
Yeah, I think I'd saved about $4,000 and I sold my HQ, which gave me about the same. And I actually rode a bike for about 9 months after that, but I had my deposit put together. So I think it was around just under 10 grand was my first deposit and costs to get into a property. But that was big bucks back then when I was earning 20 grand a year.
So you've got your deposit. And what helped you to actually make that leap from being motivated to save money to invest in property to actually signing documents and choosing where to buy and have the courage to move forward?
I'd moved to Melbourne from the country and I started working. One of the jobs I had was a store manager at one of the Safeway stores where I met my now wife. And but I also met one of my current business partners, Al Lewison. So he was working there at the same point in time. And we just sort of hit it off and started talking about property. And what I didn't realise at the start, his father, Steve, who still sits on the number of our boards of companies, was a very successful developer and property investor. And Steve grabbed us by the scruff of the neck. So I was lucky to have a mentor. That's what it came down to. Someone who I trusted, who was able to show me the ropes about property. And he's been investing for well over 50 years now. So investing for a number of decades previous to that. But I wasn't ever scared about investing in property. I had probably more fear about not investing and what my life would look like. So the concept of investing didn't worry me. I did jump in pretty boots and all. I hadn't had a borrowing capacity worked out, made a lot of mistakes that we guide people on nowadays. And what became known as what's a conveyancer day was when I signed my first contract. So I went down and Steve told me a property that was up for sale that he'd suggest buying. I went down to the agent's office and without looking at the property said, I'm ready to sign a contract. So he signed the contract without me viewing the property at all. And once again, I trusted Steve. But the what's a conveyancer day came about because the agent said, what's your conveyancer's name? And I said, what's a conveyancer? So I was pretty green early days when it came to investing, but I was lucky I had someone to guide me along the way.
What was the market like? I mean, we talked when we caught up a couple of weeks ago about sort of the market conditions right now, and it's warming up and it's going to get hot, sort of moving into 2021 and beyond. But cast your mind back to 1999 in Melbourne, and I wasn't living in Australia at the time, but Sydney was gearing up for the Olympics. How was the Melbourne market performing right then?
Yeah, you could do no wrong early 2000s, and really through those 2000s in Melbourne, you could buy anything and you would have done okay out of it. And I think that's what secured our need to invest in different capital cities early days. Both Al and I were building our own portfolios. And by the time I'd bought that one property, I'd got enough deposit to buy the second, and I duplicated my portfolio really rapidly. So, 5 or 6 properties very quickly. My wife, I got together, she was 19 at the time, and I got her into buying property. How's this, Alex? I talk about how to make an impression on your future father-in-law. So we went home, Felicity and I, to her dad's place where she was living at the time. And without his knowledge at all, we said, look, Felicity's just bought an investment property. So after he's picked his jaw up off the ground and wasn't happy with me at all, talked his 19-year-old daughter into buying a property without his knowledge, we then said, and by the way, we're building 6 units on the back of it. But, that was a good introduction, and obviously it worked out well. But you could do no wrong through those 2000s. And then the market started to stall. And I realised...
About 2003 slowed down, didn't it, in Melbourne?
Yeah, and I really wanted to continue that growth wave. And Steve telling us it's not always going to be glory days, boys, just calm down. But we realised we wanted to continue on that with that growth. So I started looking at other capital city markets and started buying heavily in Brisbane at that point in time. And the Brisbane market doubled off the back of that. So I bought 4 or 5 properties in Brisbane, and then that market doubled. So I took the equity out of that and started moving it back into Melbourne. So that was the learning curve of understanding that to catch the continual growth cycle wave, while people think about the market's growth cycles, each capital city and then markets within those capital cities have different growth cycles. So it was a real learning curve.
Look, we'll take a quick break just there and we're back in a couple of seconds.
Whether you're an avid property investor or about to buy your first property, why do it alone when you could partner with Australia's best buyer's agent? Director of Pure Property Investment, Property Investment Professionals of Australia board member and REB Buyer's Agent of the Year, Paul Glossop, can take your portfolio to the next level. Get in touch today to discuss your investment goals. Get one-on-one insight from Paul Glossop. And for the first 100 people, this service is completely free. Head to purepropertyinvestment.com today to schedule your consult with Paul Glossop directly.
Great to have you back with us. So looking at assets, Cam, and you obviously buy your first property and every investor gears up and they decide they're going to invest and then they work out what they're going to buy. And you're very fortunate that you got advice from somebody you could trust. Tell me what kind of asset you bought the first time. And then I'd like to get a bit of an idea of how those assets evolved. Did you buy the same type of property through different markets, through different cycles? Just give me a bit of an idea of that journey.
Yeah, so the first property I bought was in a suburb called Bayswater in Victoria. And believe me, I don't know what's called Bayswater. There's no water anywhere in sight. The property itself was on about 900 square metres. It was a brick veneer, 3-bedroom, inside paint job like the inside of a kindergarten. Like it was pretty rough. It needed a reno. So I did the basics, tan bark, curtains, carpet, redid the kitchen. And that was all, I think we were buying out of McEwan's back then before Bunnings had even turned up on the scene. But I realised by renovating properties, the growth actually come from the increase in the value of the land. So while all I was doing was the cheapest cosmetic reno to make the thing tenantable.
900 square metres is a good sized block. That's a nice block of land.
Yeah, it was the glory days. So we were doing dual locks and tri-ox back there, and that's what Steve taught us. So I was able to put a unit on the back of that one and obviously get uplift in both property values and move on. Like I mentioned, Felicity's first purchase, we knocked, I think, 5 or 6 units on the back of that. But then what we found was that the glory days of dual locks and tri-ox just stopped in Melbourne. So every local builder, sort of mum and dad size builder, got onto the concept of doing a dual lock or a tri-ox and just started overbidding for it. So the super profits that were there in the late 90s, early 2000s dried up pretty quick. So there was a short period of time. What Al and I did from there was we actually pulled our money together with Steve and his younger brother Matt, and we started buying sites with an end realised value of about 15 mil, so a dozen odd units or more. And that was well below the big players in town, but it was more than the average builder could afford. So that was our sweet spot for about another 5 or so years in there. So we were doing developing, but our real wealth came from holding the properties and just hanging on to them for that capital growth.
So how long did you hang on to the first place that you bought? How long did you hold that for?
Still got it, mate.
Still got it.
Yeah.
That's so good. I bought a similar time in Melbourne, and I sold mine many, many years ago. I made money on it. The Melbourne market particularly, I bought an apartment and that did ride really, really well from sort of 99 through to 2003, 2004. But yeah, look, there's a lot of investors that I speak to who say they wish they'd held on to their first property. I'm certainly one of them, so it's great to hear you held on to that.
Yeah.
It's interesting we say, sort of about announcing to your, as then sort of girlfriend's father and announcing that you dragged her into the property market. And it's interesting how people who aren't investing treat debt. And, you talk about going into debt, back then, hundreds of thousands of dollars. Now for investors, sometimes millions of dollars going into property investment. And understand the difference between good debt and bad debt is quite a hard thing. And some people just don't get it.
Yeah, I think it's one of the, I do a lot of talks for, free educational talks for year 12 kids out at secondary schools, probably when it was non-COVID times, one every couple of weeks. So I've actually done a lot of online ones with them. And while I talk about property minimally, the course is what I call money smarts. And one of the key lessons I go through with that is about assets and liabilities. So a lot of people think about assets and liabilities as two different things. And I often tease our accountants about that. I've got a dozen odd accountants that work for me full time and many different accounting firms and compliance firms that work for our company. And I often, jab them in the ribs a little bit. And while they deal with assets and liabilities on a daily basis, they don't take that knowledge and apply it to their everyday life to improve their financial situation. And don't get me wrong, accountants, the job they do is very important, but they don't practice what they preach. So the concept I go through with the kids at school and with our clients is to really understand assets and liabilities. So most people think of them as two different things. They're 4 very distinct things. So you've got appreciating assets and depreciating assets. beneficial liability, non-beneficial. So beneficial liability is obviously good debt, non-beneficial is bad debt. And some of the really basic examples, I mean, an investment property is an easy one to do. You've got the land that goes up in value. The building's only purpose is to provide rental income to support the holding cost of the land. But for the kids, I'll usually go through something like a mobile phone. You buy a mobile phone, you leave the store, is it worth more or less? Obviously less. What about the calls? That's debt. Is it good debt or bad debt? And depending on if the calls make you money, that determines whether it's good debt or bad debt. So you can start to look at everything in life and whether it falls into one of those four categories. So if you only buy appreciating assets, and the easiest way to tell whether it's good debt or bad debt is the debt attached to an asset that goes up in value. And if you only buy assets that go up in value with good debt, so that means getting rid of any cars. So the worst advice an accountant can give you is to tell you to buy a car to reduce your taxable income. Then you start to make smart money choices in life.
Debt is integral for most of us to building a property portfolio. I certainly borrowed the maximum that I could do for my first property. And generally I borrow the most I can whenever I go in the investment market now, because, you look at, as we've talked about previously, buying an asset that is as near to cash neutral or maybe in some instances cash positive for the highest amount of debt with the greatest potential for capital appreciation. But it's still, it is still something which is daunting to people. But, as you get more used to buying, the numbers get bigger and your comfort levels with those numbers also, sort of evolve and grow in lockstep.
Yeah, I think, and I often tease my mum's a great one to wind up. Like you said, the old school mentality of all debt's bad. My youngest brother, he just retired at 35 years of age because he built up a serious property portfolio. And we used to tease mum going, Rob's just another $1 million in debt, mum. So obviously she'd have that heart-stopping moment, but he knew it was good debt and it was going to give him the outcome. So if you look at the interest rate component, factor in enough buffer that if you have a tenant that's not there for a period of time and your interest rate is locked in or is going to be low for a long period of time, the reality is property prices usually move when interest rates increase historically. So as interest rates go up historically, except for the 90s recession, then the price and the rental income usually increases with it.
One of the things, Cam, I'd like to tap into in your particular unique journey is you made a move which very few investors do, which is co-invest. And you're with your co-investors still, but it's a big move to make. A lot of investors get very nervous about how to align objectives, how to manage that. As soon as money starts to become linked between a number of different people, things can get complicated. How did you instinctively know that you were investing with the right co-investors? And how did you guys communicate and manage that relationship?
Yeah, terrific question. So Felicity and I built our own portfolio and we've continued to build that. And we've built individual portfolios for each of our kids to give them when they're old enough and wise enough. But Al and I also built a property portfolio. I think I talked to Phil about this one. So I think there was 24 properties in that, resi properties, and there would have been 5 or 6 different commercial buildings that we had in that portfolio. We built that together. And that started out because we were in business together early days. We started the telco business, which started out, the normal business venture, starting out in the back of a bedroom and ended up being the largest Telstra dealership in Australia. So we're a business dealership with about 150 team members nationally. So that was a really good apprenticeship in building and managing medium-sized business. But we bought a number of different commercial buildings to put that business in. And that was really what started us out. And we thought we'd just add a few resi properties along the way. And that just built and built. But we've actually gone through the process of divesting that portfolio. So a lot of people talk about building a portfolio. Not many people talk about the back end of it. What happens when you want to get rid of the portfolio? So Al and I are going through the process. We've still got about half that portfolio left, I think. We've decided actually to hang on to a large number of the resi properties out of it, which are located in Brisbane, just waiting for the next market cycle because it's starting to kick in Brisbane. So we'll hang on to that and just get a bit more growth out of it before we sell. And the reason we wanted to sell out of that was really if we were to hand that portfolio and it's in a trust structure across to our kids in another 20 years, well, I've got 4 kids, he's got 3. Well, they're cousins as well. That's still going to be a pretty complex portfolio to manage between all those different parties. So we thought we'll divest pay the tax on it, which is obviously the biggest sort of calculation you need to do when you're going through divesting an investment portfolio. But early days, when it comes to building a portfolio, with a standard agreement, not dissimilar to what anyone should consider co-investing together, which is really, and the basis of other people co-investing together has been they can't afford a property themselves, so they go in with a friend or family member to pool their money together to be able to get into the market. And that's not a terrible strategy if you can't get into the market yourself. So you're better to be in the market with half a share than you are not at all. But a very standard, one-page agreement, which needs to be drawn up beforehand, has clearly outlined what's going to occur once the property's grown enough in value. You need to stipulate that, which enables you to sell the property, pay the tax on it, and take enough equity out each to go and buy your own and start building your own portfolios. And that's really why most people co-invest initially. But holding them long-term starts to get a bit messy, mate. After 15 years of holding a portfolio that size and divesting, we thought we'd do it before our kids get their hands on it.
Look, it's interesting you said that. Myself and Phil have been co-investors for, I've been on for about 8 or 9 years now. And we've built a reasonable size portfolio. We've got about 19 properties in there.
Beautiful.
We also invest independently. We have our own objectives in life, and we also have ours held in a trust structure. It's something for myself and Phil that's happened very organically. We were in business, in the first place, and there's a strong level of trust between us, and we're very aligned in terms of sort of our outlook and what we want to achieve with our portfolio. I think also one of the benefits, just speaking personally about co-investing, is you also share the burden and you also share that sort of view of risk. And we, like yourselves, surround ourselves with a team of people to help us making our decisions. We rely very heavily on our mortgage broker. And a mortgage broker that specifically specializes in investment. I think some mortgage brokers, they're all good, but some don't really understand some of the nuances, particularly as you start to accumulate a few properties, of structuring an investment portfolio. And also when you have a trust structure, it gets another level of complexity as well. But also, sort of having people to give advice as to where to buy, whether you want to go and get analytics and data and go and make your own decisions, or whether you want to use a buyer's agent. But it's been very successful for Phil and I. We haven't sold any properties out of our portfolio yet. So we're kind of at that accumulation level. But we're going to have to start thinking about how we start to divest from that in the future. Maybe not just yet, but it's sort of coming up.
Yeah, some good points you made there, Alex. And I think one really key point, we've got a finance broking arm and a property management arm, because we wanted to look at those two functions, and every other team member or anyone who interacts with your portfolio impacts the outcome of your portfolio. The mortgage broking scenario you came up with there, if you like, 99% of mortgage brokers in Australia, no disrespect, have got very useful means with what they do, but they don't deal with investment property portfolios. So most mortgage brokers can get you a home loan, and usually people will get a home loan through their broker, and then they'll go and get an investment property loan through them. The way those brokers, 99% of the brokers, and the way banks want the finance structured is about polar opposite as what an investor requires it to be structured to duplicate their portfolio. So it's really easy for that broker to go to the same bank you got your home loan with, cross-secure it, and get the investment loan across the line. But that's just put huge amounts of risk on your own personal place of residence, and it makes it very difficult to duplicate when you want to move forward.
You're absolutely right. I think the problem with using a mortgage broker that doesn't really understand the investment market, and more importantly, the investor, is they can look at the scenario in front of them and it's so bewildering, and they go, well, they're just not, they're not credit worthy. And this happens time and time again. So, there are so many good brokers. Like we survey borrowers that use brokers for buying their own, owner occupier homes, as well as investment properties. There's a high level of satisfaction, far higher than going direct to a lender.
Yeah.
But again, as an investor, whether you're starting out or whether you've got a portfolio that's growing, getting the right kind of understanding from your credit provider, and understanding also where to take that credit. If you get a residential broker that doesn't understand the investment market, they can sometimes take you to the wrong lender that's going to knock you back. So look, brokers are absolutely critical. They play a massive role in terms of helping grow a portfolio.
They're a must use. There's no doubt that using a broker is better than going to the bank when you're initial building your portfolio. The book, and to blow trumpets, mate, My 4-Year-Old the Property Investor that I wrote many years ago has got a chapter in there on finance and how you need to structure it. So if people can grab a copy of that off our website, opencorp.com.au, free of charge. But that gives you a clear understanding of how investment loans need to be set up to allow you to duplicate.
Good on you, Cam. Look, we'll take a quick break there and we'll be back just in a few seconds.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyer's agency.
Welcome back. Just want to dip back in for a moment, back to your journey. So, we've gone through, so the late 90s when you got into the market, you've talked us through the Melbourne market, particularly coming off sort of, early 2000s, 2003, moving into Brizzy, getting a good return. I want to bring your focus to late 2007, early 2008, when the GFC hit. I want to look at how that impacted you, your investment strategy, any fears that you had as an investor and along with your co-investors.
Yeah, we'd been operating OpenCorp for a number of years at that stage. So we had a huge amount of clients also that we were considering their portfolio and the way it was structured. And I'd been waiting for an event like the GFC, not predicting the GFC, and don't get me wrong, mate, but I've been waiting for an event like that to occur to really test our investment strategy and really the strategy that Steve had passed across to us. So in 2001, he gave me a large amounts of notes and basically documented previously what had happened through, removal and reinstatement and negative gearing, what had happened through the recession, the property prices, interest rates, and all the market drivers. And we'd been documenting this leading up to the GFC and buying, once again, medium density property, infill area and capital cities with a good affordable housing, which ensures that tenants can afford your housing through that property market down cycle, which in Australia, the medium was about 10% drop, whereas the share market was about 45% drop through the GFC. We weren't impacted like the States were with, we didn't have the issues with the way the finance industry had structured and allowed the ninja loans, so no income jobs or assets. So we didn't have the exposure to the huge drop in demand that the US markets did. So our housing market fared fairly well. In the next 18 months, we saw a huge increase in the property prices post-GFC. So the only time that people are going to be impacted by those sort of downturns or blips in the market are really if they're forced to sell. So we ensure that our clients and ourselves, we keep enough cash buffer that should we lose a tenant for a period of time, we make sure that we've got enough buffer there that we can cover the interest repayments, and then you're not forced to sell. So often Steve asked us a question, and we ask this to clients every now and then, 35 years ago, I said to you, do you think it would be a good idea to buy a property 35 years ago? Obviously, everyone says, look, I wish I bought a heap of property. But then if I said to you 35 years ago, what if in the next 35 years, you're going to have the removal and reintroduction negative gearing, a recession with 17.5% interest rates, 12% unemployment, an Asian financial crisis that lasts 3 years, smashes 60% of the global share market, 9/11 terrorism attack, a GFC that shreds the world markets, kills off the biggest banks in the world, crippling Australian credit crunch, Royal Commission into misconduct, into banking, superannuation, financial services. Are you keen to invest? The amount of yeses dropped, but the reality is the market has responded really well post all of those events. Yeah. So what we did through this COVID period was look at the documentation that Steve had given us and that I'd continued to document through all these events up until the current point through COVID, and really look at the driving factors and the type of stimulus the government puts into play during to keep the economy on idle, and then post these events and put it into the new book, Investing in the New Normal, which is out at the moment. And it's a cheap plug, mate, but we wanted people to understand, if they understand the fundamentals of the Australian market and can understand how to take what the media puts into play, they can really start to predict what's going to happen with the Australian property market. So uncertainty becomes certainty.
Mate, let's just talk about this for a second. And, I'm from the UK originally. This market is different to anywhere else in the world, I can tell you. And we went over, myself and the mortgages team, we take a delegation of people from the mortgage and lending industry here overseas. We had a study tour over to the UK just last year, and we actually went over to Ireland and had a look at the Dublin market.
Cool.
Dublin was still 40% down post GFC. It is incredible. The Australian market, when you're inside a market, you get swept around by media negativity or media positivity. You forget fundamentals, or they're obscured, for investors and for people who actually understand what's going on. So you get this real sentiment swing of, we're looking at a 10% drop and everyone gets, like kind of nervous, or we're looking at a massive load of growth and everyone gets excited. But you look historically at the Australian market, and it's not just one market. It breaks down into individual states and then capital cities and then, suburbs and so on and so forth. But it has moved forward over the years consistently. Now, some suburbs and some individual properties have done better than others, but it's very, very hard to go backwards in property over the long term. But you can certainly get burnt very badly in the short term. And if you don't have your strategy right and you don't understand where you're going, that's where investors can lose out big time.
Yeah, I think and even through this period of time, some banks and the media were predicting 30, 40% drop in property markets. And I'd have to hang my hat on and say, in specific markets, they were right. You know what I mean? But that creates the headlines. So in the apartment market, obviously, you've got a huge decrease in value in some areas. The affluent suburbs got a bit of a hit. But the area where the majority of investors or smart investors hasn't seen the impact. See, one thing I look at also on the property market, and it's interesting, we study, our economics and analytics team study the different cities overseas to try and get an understanding of their market drivers, because it obviously, world economy drives the Australian property economy also. But we also study the share market, and we've looked at a study with on the top 500 and a coinciding report through JP Morgan, and what happened in the last 20 years of investing. I think it was about an 8% return in the share market. But if you miss the top 20 trading days, the results, I think they were down to about 4%. So when we looked at the actual numbers, about 60% of the best trading days happened within a fortnight of a crash of the share market. Now, obviously, the share market is a lot more volatile, the property market, because people can sell and trade overnight. It's a liquid asset. Whereas the property market, you don't get that. People want to get the same as what they paid for it or what their mortgage is, thereabouts. And it takes about 60 days to run a campaign. So people haven't got that knee-jerk reaction, which is overall with the Australian market, and the vast difference between other capital cities in different countries is we've got the basic fundamentals. We've got an urban growth boundary, which limits supply between metro and rural and medium density, low density and high density. And we've got an increasing population growth. So once you understand those core fundamentals of the long-term supply and demand, then it's a matter of getting into each growth corridor and really finding out where the infrastructure is going, which is going to bring demand, and how much limited supply is within that growth corridor. And then really coming down to the optimum size and quality for each of those corridors. And each part of that is just reducing risk. And that's why those sort of areas, have fared really well and increased. Actually, they're faring better than they were, pre-COVID.
You talk about risk a lot, and risk is important, and risk is present in any kind of investment. If you don't like risk, then you put your money in the bank and you take whatever interest rate the bank pays you. But understanding risk and balancing risk is critical. And I look back, and the only really bad sort of period of time that I've seen in this market in any kind of macro way was really following the mining boom, and a lot of investors who maybe didn't have the right advice bought in some areas. Look, some people did very well in those areas, but again, it's those ones that come in later and come in at the back end of that particular boom. And some people lost a huge amount of money. But in general, the marketplace here with the right kind of advice has been pretty steady throughout market cycles. Yes, they can dip down 15% in certain instances. But again, I draw my analogy with, kind of the Irish market. They're still sat 40% down. And this is post sort of 2008. They don't call it the GFC over there, but post 2008 crisis. Cam, one thing I wanted to ask you, just as we're sort of talking about, kind of the ebb and flow of the property market, has there been any point where you've sat there and gone, I'm in trouble, I'm not sure what to do? Have there been any moments where you've gone, I've made a real bad decision?
Probably the biggest mistake I'd made, which ended up being financially okay, was that property I talked to. So to answer you short, no, there's no point. I'm really in trouble now. But when we bought that property for Felicity and put the design on the back of it for, I think it was 5 units now, the design that we'd done, because I'd been doing dual locks and tri-arcs up to that point, the design we did for that larger site, the draftsman drew boxes that were a lot bigger than what we'd built in the past. So what I found, there was an optimum size quality for any suburb where if you build bigger, you don't get any more in sales price. So the development, if I went ahead with it, was going to be about a break-even profit point. What I was able to do was to sell out within about 12 months for about a 200 grand increase. I think we bought it for 370 and got about a 200 grand increase in value just by selling it with plans and permits at that point in time. But that was a point when I went, I've really stuffed up here, especially with seeing it was my new girlfriend's property that she purchased, but it turned out all right. So that was probably one that I remember, but that gave us a valuable lesson. A lot of people think about overcapitalizing about fixtures and fittings, but size is the biggest thing. And the only way you can get the size right in a lot of areas is to build new, which is what I've done for the last 15 years myself.
So let's just cast back. Let's round off where we started out. You sat in the car, you with your folks, there's the argument over, milk and bread.
Yeah.
Cast yourself back to that and look back and what does the journey feel like to you in terms of that real sort of light bulb moment? How does that feel to be sitting here now and have, built a very, very large portfolio and to have helped a lot of investors along the way?
No doubt it's a good feeling. I still keep coming back to the fact that I wanted to create an environment for my kids to grow up in, which was in a reasonable suburb. We're not in one of the mega blue chip areas. We're in a middle ring suburb in Melbourne. We're in an acre here. It's a fantastic block of land. My kids have got good social friends, and they're all part of, I coach all their sports, but it really comes down to lifestyle. And this is what the really satisfying thing is. So I take 4 months a year holiday, get my kids off to school. I'm here when they get home, coach 4 of their basketball teams, their footy team. So, I mean, to a kid, mate, love is spelt TIME. Do you know what I mean? So that's what, property's given me. And if people get caught up with property, and the term I sometimes use is when people say you must love property. I'm not a bricklicker. Do you know what I mean? Some people get so passionate about property, but if rubber bands gave me capital growth and strong cash flow like property, I'd be an expert in rubber bands. It's a means to an end.
You know what? I really like that. And I think people do get very, very kind of emotionally attached to property, even though investment should be a detached approach. And, people do get very excited about property, but it is about the opportunities that it creates for you, for your family, for the people around you. Look, just in closing, Cam, and it has been a pleasure talking to you. We could talk all day. For young people tuning in, like I say, a lot of people listening to this already are in the marketplace, but a lot of people are looking for inspiration, looking for that guidance. Is there an age that's too young to start investing, or is there an age that's too late? What do you do to get started?
Yeah, I'll answer it 2 ways. So I asked Steve the exact same question, who's still my mentor today and sits on a number of boards. So he was the old guy that grabbed us by the scruff of the neck and threw me in my first property. And I said to him at the time, when's the best time to buy property? His answer was 20 years ago. The next best time is today. So getting into property now, if you buy in a property market, and considering if you're a betting person that property on average goes up about 8% thereabouts, there's more chance that in the next 12 months it's going to go up than go down. And worst case is if it goes down slightly and you have to hold it, as long as you can hold that property, you're going to be okay long term. But if it goes up dramatically, you might need more deposit to get into the market. So the best time is to buy immediately. There's no doubt about that. I've bought properties every year since the first year I've purchased, regardless. Is it too late to buy property? So my mum's 70 now, and she's about 60, and she was sort of transitioning to retirement. And she said, should I buy another property? My question to her was, do you plan to live it longer than another 10 years? Thankfully, she said yes. So she added to her portfolio just before she retired. And she's going to hold those properties, chew into her super first, use that, and then sell the properties at the back end of her life. So I don't think there's a time when you should wait to buy property. And if you can still get money from the banks and the property holds its own at the back end of life, you should buy property.
Time to buy property is now. It's just a matter of making sure that you do your due diligence, that you get advice and assistance, and that you have a good team around you. But now is the time to buy.
Yeah, buying property is like a bag haircut, mate. Time fixes everything.
I like it. Cam, it has been so good catching up with you again. Thank you so much for making time to join us.
No, it'd be good to catch up for a coffee or beer once again, Alex. I look forward to it.
For everyone else, thanks so much for tuning in. I think that's a really valuable insight into a very significant journey through property, starting out in 1999, plunging in feet first, having courage to get in there and to do the things that really sparked by hearing a pretty distressing situation for his parents. Look, there's been a big journey for Cam and also for his partners, and they've built a successful business off the back of it. It's been great having you with us. Really appreciate your time. Thanks so much for listening. Don't forget, make sure if you like this podcast, give us a good rating, tell your friends, share it. We're on all the usual social media. We look forward to catching up with you again. Thanks very much.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.